All right, let's bring in Shannon Saccocia of NB Private Wealth and Kevin Gordon of Charles Schwab. Shannon, of course, a CNBC contributor, broaden out this conversation a little bit. And Kevin, let's start with you. But in terms of the equity market dynamics recently, it's as if the months and months of complaint that this rally was too narrow and we needed to see breadth come around, the market said, OK, we'll give it to you all at once in the last few days. So where does that leave you with regard to whether this is sustainable?
Yeah, it's interesting because the kinds of breadth divergences that have been, widely advertised, we've talked about them a lot over the past few months, especially if you take it, back to late March. They don't tend to get resolved by the average stock or the rest of the market catching up to the index level. There's typically a little bit more of a convergence. But of course, courtesy of the move last week from small caps and deeper cyclicals, it's been resolved in a nicer way. So I do think that it gives the market a little bit more runway. But I think what's probably coming more into focus now in terms of where the downside risks lie is and much in keeping with what Rick was talking about in terms of inflation, coming back to something that looks a little bit more normal. It's definitely not normal in absolute terms, but relative to where we've been, it's normalizing. But I think that we're sort of removing inflation as the main risk now in terms of an upside surprise and turning higher, and introducing the labor market now more as something to focus on. And rightfully so, the Fed has been focusing on that. We know that they're now viewing both parts of their mandate in focus, in balance, and I think that's probably the right way to think about it from an equity market perspective.
Shannon, as a fundamental stock picker, you're trying to figure out corporate earnings name by name. I would imagine that this might be setting up as a more rewarding environment, but how are you viewing it so far in terms of whether the market looks like, it can sustain in this way for a while?
Rewarding would be great, for sure. But, Mike, I would caution, a lot of the language that we're hearing over the last couple of days, it sounds a lot like November and December of last year, where we were staring down the barrel of 6 to 7 rate cuts, where we had really felt like some of the volatility around Treasury yields had dissipated. And so I think, we're really looking at this as an opportunity for us to capture that earnings growth in the second half of the year. And if you look at the comps for sectors outside of technology, those earnings revisions have been pretty positive. And so from our perspective, Rick was mentioning this before, trying to find those pockets, whether it's energy, industrials, financials, materials, healthcare, where you anticipate that second half of the year, you're going to yield that earnings growth. It's not that we need earnings growth in those other sectors to even start to look like the 7 to 10 names that have really run over the last 18 months. It's that delta it's starting to compress a little bit. And so that's where the opportunity is, I think, for those who are looking for the broadening out trade to persist.
And Kevin, I guess the other piece of this is, we're getting this rotation, and so far it's been painless, right? The big cap indexes have not given much back in terms of their gains for the year, and in fact have come into this week looking maybe even a little bit stretched on the S&P 500 level. And it's not as if people have been kind of out of the market and expecting bad things as we get into this period. So I just wonder how that fits into your tactical view here. Yeah,
that's really, I think, the right way to think about it. Often when you pit the mega caps versus the rest of the market, it's often thought of in this way that it's a zero-sum game where only one group can do well at the expense of the other. But we know in the case of a bull market that looks relatively healthy, which we're starting to see better signs of health and improvement. But in typical bull markets, it's sort of a rising tide that lifts everything together. So I think, there's still more of the catch-up trade to do for deeper cyclicals, or even to some extent defensives. I think that's one of the reasons that utilities, for example, did well earlier this year, because they had such a tough time at the end of last year. But I think for the most part, if it fits with how we've been thinking about the economy and how disjointed this cycle has been in terms of some pockets of the economy taking longer to recover, as you're now starting to see softening in areas like services, that I think will benefit over time, a broadening of the rally. It's just not going to happen, perfectly and at one time. Mm-hmm. So I think instances like last week are sort of this, rubber band moment where you get a snapback in the names that have been lagging, but it's realization on the part of investors that overall the economy is hanging in there and remaining resilient.
Shannon, the market's trying to behave as if maybe this is a year when the seasonal choppy period ahead of an election, or that sort of uncertainty, move to the sidelines type effect, maybe isn't going to come around, although maybe that's exactly when it starts, when nobody expects it. So what are you thinking in the next few months in terms of how this market might proceed?
Well, if you just overlay what we've seen historically in presidential election years, Mike, as you know better than I do, we've seen a lot of that performance be pulled forward. And so do we see that volatility potentially be pulled forward? Maybe. I think, if you looking at an earnings-led market, earnings-led markets do generally tend to be less volatile. And so that is a tailwind for us. The other thing, though, is just the confluence of factors that are coming to play in that late August, September timeframe. And so you usually see election-related volatility pick up after Labor Day. Maybe we see that creep into August, though, because we've got Jackson Hole as well. And so maybe we see that happen, that sort of 6-week period start a little bit earlier. But again, this is an extraordinary period where we've known the candidates much earlier than anticipated. Obviously, there's been some questions about that in the last 10 days or so. But I think, just looking at it from a blueprint perspective, maybe you can't look at the historical precedent, but there is probably some rhyming, albeit, complicated a bit by what we're expecting from the Fed between Jackson Hole and the September meeting.